October 31st, 2008. The world is collapsing. Lehman Brothers has just filed for bankruptcy. The global financial system is on life support. Banks that were too big to fail are failing. Millions of people are losing their homes, their savings, their trust in the institutions that were supposed to protect them. And on that exact day, someone using the name Satoshi Nakamoto publishes a 9-page document to an obscure cryptography mailing list. The title? Bitcoin, a peer-to-peer electronic cash system. The timing wasn't a coincidence. It was a manifesto. The idea was revolutionary. What if money didn't need banks? What if you could send value directly to anyone, anywhere in the world, without asking permission from governments or corporations? What if we could build a financial system that couldn't be manipulated by central banks printing money or institutions gambling with customer deposits? 3 months later, January 3rd, 2009, Satoshi mines the first Bitcoin block. Embedded in the code is a message, a timestamp from that day's London Times. Chancellor on brink of second bailout for banks. It was a statement of purpose. Bitcoin was born from the ashes of financial corruption. Here's how it worked, explained simply. Imagine a notebook that records every transaction, but instead of one bank keeping that notebook, thousands of computers around the world each have an identical copy. When someone sends Bitcoin, every computer checks and updates their notebook. No single person controls it. No one can cheat because everyone is watching everyone else. That's the blockchain, and it was genuinely innovative. For the first year, Bitcoin was worth essentially nothing. A handful of cryptography enthusiasts and cypherpunks mined it for fun. Then, on May 22, 2010, something remarkable happened. A programmer named Laszlo Hanyecz paid 10,000 Bitcoin for 2 Papa John's pizzas. At the time, that was about $41 total, roughly $0.00041 per Bitcoin. It was the first real-world transaction. Bitcoin had become actual money. The price started climbing. February 9th, 2011, Bitcoin hits $1 for the first time. June 8th, 2011, it reaches $31.91. People are starting to pay attention. Then reality hits. By November 18, 2011, Bitcoin crashes to $2.01, a 94% collapse. Welcome to crypto volatility. But here's the thing most people miss about Bitcoin's origin story. It was never as decentralized as the mythology suggests. Satoshi Nakamoto is estimated to own roughly 1 million Bitcoin. That's about 5% of all Bitcoin that will ever exist, worth around $45 billion at today's prices. And those coins have never moved, not once. So from day one anonymous person controlled more wealth in this decentralized system than entire nations. We don't know who Satoshi is. We don't know if they're alive. We don't know if they're one person or a group. But whoever they are, they're potentially one of the richest entities on Earth. And in 2011, Satoshi vanished, just disappeared, left the project, stopped communicating, gone. That's the first lesson about Bitcoin. The promise of decentralization ran headfirst into the reality of power concentration from the very beginning. But the real manipulation, the fraud that would shape cryptocurrency for years to come, was just getting started. By 2013, Bitcoin is gaining serious momentum, and if you wanted to buy or sell Bitcoin, there was really only one place to go: Mt. Gox. Mt. Gox started as a website for trading Magic the Gathering cards. Seriously, Mt. Gox stood for Magic the Gathering Online Exchange. A French programmer living in Japan named Mark Karpeles bought the site and transformed it into a Bitcoin exchange. And somehow, this website, originally designed for trading fantasy game cards, became the center of the entire cryptocurrency universe. At its peak, Mt. Gox handled an estimated 70% of all Bitcoin trading worldwide. Think about that. 7 out of every 10 Bitcoin transactions flowed through one company, run by one guy operating out of Tokyo with minimal oversight and questionable security. If Bitcoin was supposed to be decentralized, this was the exact opposite. All that power concentrated in one place. It was a disaster waiting to happen. And in 2013, something strange started occurring. Bitcoin's price began rising dramatically. November 2013, Bitcoin hits $1,136, an all-time high. The media is going crazy. Bitcoin is everywhere. People are making fortunes. Celebrities are shilling coins. Your Uber driver is giving you crypto tips. It's mania. But here's the question. What drove that astronomical rise? Was it genuine adoption, growing recognition of Bitcoin's value, or was something else happening behind the scenes? Enter Tether. And this is where things get complicated and controversial. Tether is a stablecoin, a cryptocurrency that's supposed to be worth exactly $1. The concept is simple. For every Tether coin in circulation, Tether Limited supposedly holds $1 in a bank account. It's meant to be a stable bridge between the volatile crypto world and real currency. But here's the problem. There's substantial evidence suggesting Tether wasn't actually backed by dollars. Instead, researchers allege Tether was printing billions of coins out of thin air and using them to buy Bitcoin, artificially inflating the price. Let's look at the timeline of Tether issuance in 2017. March 2017, Tether issues $100 million in new USDT. Within weeks, Bitcoin jumps from $1,200 to $2,982. September 2017, Tether prints $443 million in new USDT. Bitcoin climbs from $4,400 to $7,882. November-December 2017, Tether issues an astonishing $850 million in new USDT. Bitcoin explodes from around $9,000 to its all-time high of $19,783. Coincidence? Maybe, but researchers weren't convinced. In 2018, researchers at the University of Texas published an academic study examining Tether's role in Bitcoin's price movements. Their conclusion? Approximately 50% of Bitcoin's rise in 2017 could be attributed to Tether-related manipulation. The pattern was clear. Whenever Bitcoin's price dipped, massive amounts of Tether would be created and used to purchase Bitcoin, pushing the price back up. Think of it this way. Imagine you could print fake dollars, use them to buy gold, driving up gold's price, then cash out using real dollars. That's essentially what Tether is accused of doing. Print unbacked USDT, buy Bitcoin, drive the price up, and then cash out. It's counterfeiting, except it's happening in a largely unregulated market. Tether and its affiliated exchange Bitfinex were run by shadowy figures, primarily Giancarlo Devasini and Phil Potter. Unlike traditional financial institutions, these companies operated with minimal transparency. Where were the bank reserves? Were they being audited? Could they actually redeem all the Tether they'd issued? For years, Tether insisted they had the backing. They'd release vague statements claiming full reserves, but they never provided a comprehensive, independent audit. Then, the evidence started piling up. In 2019, the New York Attorney General's office launched an investigation. Their findings were damning. Bitfinex had lost $850 million in customer and corporate funds and had secretly covered the shortfall using Tether's reserves. Moreover, Tether's claims of being fully backed by US dollars were false. The reserves included not just cash, but also loans, other cryptocurrencies, and various other assets. Tether settled with New York for $18.5 million and was banned from doing business with New York residents, but they admitted no wrongdoing. In 2021, Tether settled with the CFTC, Commodity Futures Trading Commission, and paid a $41 million fine. This time, they admitted that for significant periods between 2016 and 2019, Tether coins were not fully backed by US dollars as claimed. For months at a time, the backing was as low as 10% actual cash. Let me repeat that. The stablecoin that was supposed to be 100% backed by dollars was sometimes only 10% actual cash. The other 90%? Promises, IOUs, and wishful thinking. So, what happened when the 2017 mania ended? Reality arrived. By December 15th, 2018, Bitcoin crashed to $3,193, an 84% decline from its peak. About $250 billion in market capitalization simply evaporated. The people who bought Bitcoin in December 2017 watched their investments lose more than 80% of their value in 12 months. The suicide hotline number got pinned to cryptocurrency forums. The stories of lives destroyed, college funds gambled away, retirement accounts decimated, or heartbreaking. And here's the kicker. Tether still exists. As of 2024, there are approximately $83 billion worth of Tether coins in circulation. It's the third largest cryptocurrency by market cap. And while Tether now publishes attestations from accounting firms, these aren't full audits. The exact composition of Tether's reserves remains murky. Critics call Tether a ticking time bomb. If it's not fully backed and people lose confidence, a rush to redeem Tether could trigger a catastrophic collapse across the entire cryptocurrency market. Supporters say Tether has evolved, improved transparency, and is now legitimately backed. Who's right? That's the $83 billion question. But one thing is certain. Tether manipulated markets in the past. They admitted it in legal settlements. Whether they're still doing it is a matter of fierce debate. While Bitcoin was experiencing its meteoric rise, another phenomenon was sweeping through crypto, the ICO boom. ICO stands for Initial Coin Offering. Basically, anyone could create their own cryptocurrency and sell it to investors. The pitch was always the same. We're building the Uber of blank on the blockchain, or the Amazon of something, the Airbnb of whatever. Just add blockchain, create a coin, write a white paper that sounds technical, and boom, you're raising millions. In 2017, ICO projects raised $6.9 billion. In 2018, that number jumped to $21.6 billion. Billions of dollars flowing into projects that, in many cases, were nothing more than ideas on paper. No product, no revenue. Sometimes not even a functional team. The most infamous was BitConnect. It promised returns of 1% per day. That's 365% per year. Obviously unsustainable, obviously a Ponzi scheme. But people were so caught up in cryptomania that thousands invested anyway. At its peak, BitConnect had a market cap over $2 billion. January 2018. BitConnect collapsed, the classic Ponzi exit. Founders disappeared, investors lost everything. Later analysis revealed it was a textbook Ponzi, paying early investors with new investor money until the whole thing imploded. Then there was OneCoin, which stole an estimated $4 billion from investors across the globe. Its founder, Ruja Ignatova, literally disappeared and is now on the FBI's 10 most wanted list. OneCoin wasn't even a real cryptocurrency. There was no actual blockchain. It was pure fiction. But OneCoin and BitConnect were just the spectacular failures. A 2019 study analyzed ICO projects and found that 80% were outright scams, 11% failed despite being legitimate attempts, and only about 8% actually made it to cryptocurrency exchanges for trading. That means if you invested in a random ICO, you had an 80% chance of being scammed and only an 8% chance of getting a coin that could even be traded. The manipulation didn't stop with fraudulent projects. It extended to how they were promoted. Enter the pump and dump schemes. Here's how they worked. A group of insiders would buy a low-priced shitcoin for pennies. Then they'd coordinate massive hype campaigns, Telegram groups, Discord servers, Twitter campaigns. They'd get influencers involved. John McAfee, the famous and infamous antivirus software creator, was later charged with the SEC for accepting over $105,000 per tweet to promote various cryptocurrencies to his followers. He'd tweet, "This coin is revolutionary," and his hundreds of thousands of followers would buy, driving up the price. Then McAfee and the insiders would sell, pocketing the profits while regular investors watched the price crash. This happened dozens of times with different coins. It was systematic wealth transfer from uninformed retail investors to connected insiders. Then there's wash trading, one of the most insidious forms of manipulation. Here's how it works. An exchange creates fake trades between accounts it controls. It looks like millions of dollars are being traded, but it's actually the exchange buying from itself and selling to itself. It's like a car dealer buying his own cars back and forth to claim he's the busiest dealer in town. Why would exchanges do this? Volume attracts traders. If an exchange shows huge volume trading, it looks legitimate and active. More users sign up, more fees collected, everyone wins, except the users who don't realize the volume is fake. A 2019 report by Bitwise Asset Management analyzed cryptocurrency exchange volumes and concluded that approximately 95% of reported Bitcoin trading volume was fake. That bears repeating, 95% fake. Only about 5% represented real people trading real Bitcoin. The report analyzed patterns and found that most fake volume showed two perfect statistical distributions. Real trading is messy. Humans are irrational, make mistakes, trade at odd times. Fake volume from bots showed unnatural patterns, trades happening every second on the second, perfect round numbers, no irregularities. When Bitwise presented their findings to the SEC, it revealed an uncomfortable truth. The cryptocurrency markets were overwhelmingly fraudulent. The numbers everyone saw on websites like CoinMarketCap, mostly fiction. Some exchanges have since cleaned up their act, especially ones based in regulated jurisdictions, but wash trading still happens, especially on offshore exchanges beyond regulatory reach. So by late 2018, the picture was clear. The ICO boom was mostly scams, exchange volumes were mostly fake, influencers were getting paid to pump coins, and retail investors, regular people, were losing everything. The Wild West era of crypto had claimed countless victims, but the institutional era was about to begin, and with it came even more sophisticated manipulation. March 12, 2020. The COVID-19 pandemic triggers a global market panic. Everything crashes: stocks, commodities, and yes, Bitcoin. In a single day, Bitcoin drops from around $7,900 to $3,850. Crypto enthusiasts had claimed Bitcoin was digital gold, a safe haven independent of traditional markets. That theory died in March 2020. But then something changed. Institutional money started flowing into Bitcoin. August 2020, MicroStrategy, a publicly traded business intelligence company, announces it's buying $250 million worth of Bitcoin as a treasury reserve asset. CEO Saylor becomes Bitcoin's most vocal corporate advocate. Bitcoin jumps to $11,000. October 2020, PayPal announces it will allow customers to buy, sell, and hold cryptocurrency. Bitcoin climbs to $13,000. Institutional legitimacy is building. December 2020, Bitcoin breaks its 2017 record, reaching $28,990. By January 2021, it hits $41,986. February 8, 2021, Tesla announces it has purchased $1.5 billion in Bitcoin and will accept Bitcoin as payment for vehicles. The news sends Bitcoin soaring toward $58,000. Elon Musk becomes crypto's unofficial leader. April 14, 2021, Coinbase, the largest U.S. cryptocurrency exchange, goes public with a direct listing on NASDAQ. The same day, Bitcoin peaks at $64,804. The crypto industry feels like it has finally arrived. Legitimacy, institutional backing, public markets. Then the most powerful man in crypto tweets. May 8, 2021. Elon Musk hosts Saturday Night Live. During a skit, he calls Dogecoin, a literal cryptocurrency created as a joke, a hustle. Dogecoin crashes. Bitcoin drops to $49,000. May 12, 2021, Musk tweets that Tesla is suspending Bitcoin payments due to environmental concerns about Bitcoin mining. Bitcoin plummets to $46,000. Think about that. One person's tweets moved a $1 trillion asset class by tens of billions of dollars. Is that market manipulation? Legally, it's unclear. Cryptocurrency regulations are murky. But in crypto, it was just another day. May 19th, 2021, China announces a comprehensive ban on cryptocurrency mining and trading. Bitcoin crashes to $30,681, a 53% drop from the April peak. By July 20th, 2021, Bitcoin bottoms at $29,796. The institutional bull run appears to be over. Half the market cap gone in 3 months. But crypto believers held faith, and by November 10th, 2021, Bitcoin reached a new all-time high, $68,789. This was it. Institutional adoption, mainstream acceptance, to the moon. At the center of this new bull run was a company called FTX, led by a 29-year-old MIT graduate named Sam Bankman-Fried. Sam Bankman-Fried, or SBF as he was known, became the face of crypto's institutional era. He wore shorts and t-shirts to meetings with billionaires. He slept on a beanbag in his office. He claimed to be an effective altruist, someone who makes money specifically to give it away to good causes. He testified before Congress. He met with heads of state. He ran Super Bowl ads featuring Larry David. By November 2021, FTX was valued at $32 billion. SBF himself was worth an estimated $26 billion, making him one of the richest people under 30 in the world. FTX was supposedly different from the old crypto exchanges. It was based in the Bahamas but sought regulatory compliance. It had celebrity endorsements from Tom Brady, Steph Curry, and Gisele Bündchen. It sponsored sports arenas. It looked legitimate. Behind the scenes, FTX was committing one of the largest frauds in financial history. November 2nd, 2022. CoinDesk, a crypto news outlet, publishes a bombshell investigation into Alameda Research, a trading firm also owned by SBF. The report reveals that Alameda's balance sheet is heavily concentrated in FTT, FTX's own cryptocurrency. Red flags everywhere. November 6th, 2022. Changpeng Zhao, CEO of Binance, FTX's main competitor, tweets that Binance will sell its holdings of FTT tokens. The price of FTT starts collapsing. November 8th, 2022. Bank run. Customers try to withdraw $6 billion from FTX in just 72 hours. FTX freezes withdrawals. Binance announces it will acquire FTX to save it. Hours later, after reviewing FTX's books, Binance backs out. Whatever they saw was so bad they wanted nothing to do with it. November 11th, 2022. FTX files for bankruptcy. Approximately $8 billion in customer funds is missing. Where did the money go? The story is almost incomprehensibly brazen. SBF had been taking customer deposits from FTX and using them to make risky bets at Alameda Research. Customer money, money that was supposed to be safe and available for withdrawal, was gambled on crypto trades, venture investments, and political donations. When the market turned and those bets went bad, there was nothing left. It was a simple fraud, executed at massive scale. Customers deposited real dollars thinking they were safe. SBF spent them. When customers wanted their money back, it was gone. Bitcoin crashed from around $21,000 to $15,479 by November 21st, 2022, a 77% drop from the 2021 all-time high. Billions of dollars in market value evaporated as contagion spread. FTX customers discovered they might never see their money again. December 2022. Sam Bankman-Fried is arrested in the Bahamas and extradited to the United States. His trial in late 2023 was remarkable. Prosecutors presented evidence of systematic fraud, commingled customer funds, fabricated balance sheets, lies to investors and customers. The defense was essentially, "I didn't mean to." SBF testified in his own defense and said, "I don't recall," or variations thereof, 140 times. November 2nd, 2023. The jury deliberated for just 4 hours before convicting Sam Bankman-Fried on all 7 counts of fraud and conspiracy. He faces up to 110 years in prison. The FTX collapse destroyed the narrative that institutional involvement would clean up crypto. A company valued at $32 billion, endorsed by celebrities, invited to testify before Congress. It was all built on fraud. The same fraud that had plagued crypto since Mt. Gox, just bigger, more sophisticated, more destructive. So where are we now? As of early 2024, Bitcoin trades around $45,000. It has survived Mt. Gox. It has survived Tether controversies. It has survived the ICO scam era. It has survived FTX. Despite multiple 80+% crashes, despite billions in fraud, despite countless obituaries, Bitcoin is still here. And that in itself tells us something important. Here's what we know for certain. We know exchanges have manipulated markets. Mt. Gox's Willybot is documented. FTX's fraud is proven in criminal court. Multiple exchanges have been caught wash trading. We know Tether manipulated prices. The company admitted in legal settlements that their coins weren't fully backed as claimed. Academic research suggests substantial market manipulation during 2017. We know whales control the market. Estimates suggest the top 2% of Bitcoin addresses control approximately 95% of all Bitcoin. When these entities move, markets move. We know retail investors usually lose. The pattern repeats. Insiders accumulate during bear markets at low prices. Media hype builds. Retail investors buy near the peak. Crash. Repeat. But here's what remains genuinely uncertain. Is Bitcoin's current price legitimate or manipulated? Some argue the market has matured, institutions bring legitimacy, and price reflects real supply and demand. Others point to Tether still printing billions in USDT with questionable backing, wash trading continuing on unregulated exchanges, and whale manipulation ongoing. Can Tether survive scrutiny? $83 billion in Tether exists. If even 20% of holders tried to redeem simultaneously and Tether can't honor those redemptions, the entire crypto market could crash catastrophically. Is Tether actually fully backed now? They release attestations, not audits. We don't really know. Will regulation help or kill crypto? Bitcoin's original promise was freedom from regulation, but fraud thrives in unregulated markets. Recent moves towards regulation, the SEC approving Bitcoin ETFs, the EU implementing comprehensive crypto rules, might bring legitimacy, or they might kill the very thing that made crypto unique. What happens when Satoshi's Bitcoin moves? There's approximately $45 billion worth of Bitcoin that hasn't moved since 2011, presumed to belong to Bitcoin's creator. If those coins suddenly start moving, whether Satoshi returns or someone crocs the private keys, the market impact would be catastrophic. Here's the difficult truth. Both sides of the Bitcoin debate have legitimate points. The crypto skeptics are right that markets have been systematically manipulated. Most participants lose money. Fraud is rampant. Many promises of blockchain technology haven't materialized. Environmental concerns about energy usage are valid. The space remains filled with scams. The crypto advocates are also right that blockchain technology is genuinely innovative. Decentralized networks have real value. Bitcoin has survived every prediction of its death. Institutional adoption is increasing, and in some countries with unstable currencies, crypto provides real utility. The technology is still evolving. What's clear is that cryptocurrency operates in a paradox. It promised decentralization, but became centralized. It promised freedom from manipulation, but became one of the most manipulated markets in existence. It promised empowerment, but mostly enriched insiders and early adopters at the expense of regular people who bought in late. Mt. Gox, centralized exchange, manipulated, collapsed. Tether, unbacked stablecoin, manipulated 2017 bull run, continues operating. FTX, centralized exchange, defrauded customers, collapsed. The pattern is unmistakable. The house, whoever controls the exchanges, whoever controls the most coins, whoever can print unbacked stablecoins, the house always wins. And yet, Bitcoin survives. Either it's the most resilient scam in history, or it's genuine innovation repeatedly sabotaged by bad actors, or it's something in between, a technology with real potential that keeps getting hijacked by greed. Here's what I believe the evidence shows. Bitcoin and blockchain technology represent genuine innovation. The core idea, a decentralized ledger that no single party controls, that's revolutionary. But the implementation, the ecosystem built around it, has been consistently corrupted by the same human behaviors that plague every financial market: greed, fraud, manipulation, and the exploitation of information asymmetries. The question isn't if Bitcoin has been manipulated. The evidence is overwhelming that it has been. The question is, can a market with this history of manipulation, this concentration of power, this pattern of fraud, ever become a legitimate, trustworthy financial system? Or is cryptocurrency simply the greatest wealth transfer from the uninformed to the informed, from the late to the early, from the poor to the rich in modern financial history? I don't know the answer. Nobody does. Bitcoin might hit $500,000. It might crash to $1,000. It might become the global reserve currency. It might be remembered as the tulip mania of the 21st century. But one thing is certain. If you're thinking about investing in cryptocurrency, understand this. You're not investing in technology. You're entering a market where proven manipulation has occurred repeatedly, where the largest holders can move prices at will, where exchanges have a history of fraud, and where you have far fewer protections than traditional financial markets. Maybe that's the price of financial revolution. Maybe it's worth it. Maybe things are getting better. Or maybe the house always wins. And in crypto, the house is whoever has the most Bitcoin.